Hello and welcome to the Investing on the Go podcast. I'm James Yardley and today I'm joined by Martin Lau, the fund manager of the FSSA Greater China Growth Fund. Martin, thank you very much for joining us.
Hello, James.
Martin, you've got over 2 decades of experience investing in Chinese equities, so hopefully you're the perfect person to talk about at the moment for the current situation. We've heard a lot about Evergrande recently, this huge Chinese real estate company which has got into a bit of trouble. Mm-hmm. What are your thoughts on it? What does it mean for the whole Chinese economy?
Yes, thanks, James, for inviting me to talk here. Yes, first of all, Evergrande is the largest developer in China with a lot of debt. It's estimated that it has 2 trillion renminbi worth of debt. So the fall of Evergrande is a very major event. Being the largest developer, having some problems, in our view, it highlights a few facts. The first fact is that China is a leveraged economy. So for many years, our view has been that there's a lot of highly leveraged company in China. China credit to GDP is one of the highest in the world, over 300% of GDP. So China is basically an over-leveraged economy, and because of that, it's always been our view that in many ways the best area for investment in China is not necessarily a Chinese bank or a Chinese developer. So that's one. The second thing that we learned from this incident is that the Chinese government is really quite determined to tackle the property market. So for 3 years, the Chinese government has been trying to curb property price increase and has not been as successful. So they've been trying different ways, including cutting out the financing or the funding of some of the developers. So it shows the determination of the Chinese government, in tackling the very high property prices. We do not though think that this is like the end of the world, or some people say it is the Armageddon, Lehman crisis, etc. And the very simple reason is that it was kind of orchestrated by the government in the first place. China is a closed system. There are very little foreign capital in China. It has got a closed capital account, and all the banks are owned by the government. So if the government wants, they can always stop the next Evergrande from happening. Yes. So the similar type of when Lehman happened, it was really the loss of trust, the counterparty risk, the complicated counterparties and derivatives that Lehman Brothers had at that point in time. And I think the situation now is different. But then back to the original point is China is, debt level is high, and the fall of Evergrande pretty much reflects that fact.
And we've seen the Chinese government increasingly crack down on various different sectors recently, such as technology or education or gambling. What does this mean for investors? Is China still investable at the moment? Does the Chinese government care about the performance of the stock market?
Yes, that's a very good question. So first of all, we have also been quite surprised by the frequency of regulation covering different sectors that you just mentioned, from online games to education to like e-commerce delivery, gambling, etc. So it does seem to us that the government is very keen to increase the kind of control on the economy. It shouldn't be surprising in a way, because China has always been relatively top-down economy or top-down government. Last year China was credited for managing the COVID situation very well, because they control pretty much everything within the economy. So now it's happened with the regulation. It highlights the kind of risk which arguably has always been there. There are a few things which we take from the different regulations. First of all, it is in a way good that investors are aware of this risk. So if we turn back to last year, for example, everyone believed China is the area to invest. And within China, you should buy Tencent, Alibaba, Meituan, or Pinduoduo, etc., all those tech companies. Of course, the sentiment has now changed almost 180 degrees. But we believe that's in a way quite good, because investors are now aware of those risks. It is our view always that the best time to buy China is when people are nervous about China. So for different reasons. So the fact that regulation is now happening and people are concerned about it is a good thing. The second thing, which we take from the regulation, is that indeed the Chinese government, a lot of the commentators say it's become more socialist. It is true, but then one also need to remember China has always been a socialist country. For many years, one could easily argue China is a communist country, but it was probably the most capitalist country in the world. And I think this is more like a normalization to a more socialist, stance. And I think this is also quite right in a way. So when you say the government talks about common prosperity, you may not like this term because whenever you listen to this term, you think about maybe does it mean that it would hurt the investors? Does it mean that no one can make money? Our interpretation of that stance, common prosperity, is that the government wants everyone to get more equally rich, as in people become also richer, but then the disparity may not be as big as before. I do believe this is one of the challenges for different governments, especially after COVID and with property price going through the roof in many other countries, that the wealth disparity is getting bigger and bigger. So the government really want to address that, but it doesn't mean that they want everyone to be poorer. It doesn't mean that they want economic growth to be negative. It doesn't mean that they want to destroy innovation, industrial development, etc. It just means they want to adopt a more balanced approach, trying to make sure that the lower income people are also taken care of.
And I think the fall in the value of the Chinese stock market has caused Tencent to drop outside of the world's largest top 10 companies. This is for the first time, I think, since 2017. What does this mean for China? Will we see Chinese companies bounce back and return to the top 10 again soon?
Yeah, I think it is quite possible. So first of all, in many ways, we actually we actually think the fact that a Chinese company drop out of the top 10 is actually quite good. Because if you look back to past, it's almost like a curse if you become the largest in the world. I believe ExxonMobil was once the largest company in the world, for example, and PetroChina the same. And the banks were once largest in the world, China Mobile, etc. So I think the fact that it's out of the top 10 reflect the fact that Chinese stock market has actually fallen quite a lot in recent months. It is in a way good. Whether they will come back to the top 10 again really depends on the stock market. But we'll probably focus on why Chinese companies become the largest in the first place, and whether if it ever come to the top 10, what would happen. The reason why Tencent became one of the largest in the world in the first place top 10 is, first of all, China is a very big domestic market. It is 1.4 billion people. And secondly, of course, Tencent has done something right, as in it created a very successful and very huge ecosystem led by WeChat. And therefore, they start to do different things. And more importantly, is how, when you're given some chance and incentive, how certain people can apply innovation and create a more successful business. So if those are drivers like big market innovation and the right people, the right incentive, etc., come into place, I do believe there's every chance that China company can be big in the world, but it may not be Tencent, it could be another company.
Now, looking more closely at your portfolio, you've got about 16% in Chinese A shares at the moment. Can you briefly explain to our listeners what those are and the opportunity with them?
Yes, that's a very good question. First of all, within China, the thing which get me most excited, or the team most excited, are the Chinese A share companies. For those of you who are not as familiar, Chinese A share companies were actually close to foreign investments for many years until around 10 years ago. It is the domestic market of China. And why it is important is, first of all, the Chinese A shares is a very deep market. There are actually more than 4,000 companies listed on the A shares. And in market cap terms, it's actually more than $4 trillion. It's actually the second largest stock market after the US market. So it is a big and deep market. And for us, FSSA, one of the excitement is that we want to stock pick from a huge universe of different companies. It's always very exciting to find an entrepreneur introducing his or her company and you can feel the drive and the passion of that individual. So A shares is an area that we would continue to invest into, and this number 16% will continue to increase over time, depending on the opportunity. Within A shares, we identify different opportunities. Because of the A shares are so big, there are different leaders in different industries. For example, in the home appliance industry, we're invested into a company called Media Group. It's actually the largest home appliance company, a bit similar to Whirlpool or General Electric in the Western world. And the reason why we like this company, just to elaborate into more details, is because we like the management. It's a professional management. It's family owned. It's owned by a family with the surname He. If you make any it's not that important, but it's Mr. He. And it really a place whereby the company moved from a kind of cheap and cheerful electric fan company many years ago into now a business spanning from home appliance, smart devices, and also they are also into robotic. They bought a robotic company in Germany a few years ago. So this is a very good example of how a Chinese company can move up the manufacturing value added. And this is one of the major themes that we identify. Is that let's say 20 years ago, China was very good in making shoes and garments, and is now trying to move into more value-added products, led by the example of Huawei, which is really the leader in smartphones and telecom equipment. So media is one example.
And your fund, of course, is a Greater China fund, meaning you can invest in Taiwan as well. In fact, you've got about a third of your portfolio in Taiwan at the moment. Is that a defensive move, or are you simply finding better opportunities there?
Yes, that's an interesting question. So historically, we've told our clients that a Greater China fund is different from a pure China fund in the sense that it is a more diversified set of opportunities. You probably know and can appreciate in recent months that China is actually a very volatile market. It's either the best performing or the worst performing if you think about the China-Asia market, and very rarely in between. So for the last 2 years, it was the best performing, and then now it's become, at least up to now, one of the not as good performing markets in the whole world. So by introducing Taiwan and Hong Kong into the mandate or portfolio, first of all, it creates diversification. There is often the case. For example, this year, let's say China is not doing well, and Taiwan semiconductor stocks have actually performed extremely well. By that, it creates the kind of like diversification and also the room to maneuver away whenever you feel there's a kind of like a bubble in certain areas. We do believe, for example, last year there was a little bit of a bubble with China Tech, and then maybe you can move the money into Taiwan. And this year, we believe Taiwan semiconductor is a little bit of a bubble. And the reason for that is the whole world is believed that there's a severe shortage of chips, which will last for maybe 2 or 3 years. Whether that concern is true or not, the likes of TSMC has actually appreciated significantly. So as a portfolio, right now, what we have done is that we have trimmed a little bit of TSMC. It's still our favorite, it's still the largest position in the portfolio, but because it's done so well at a time when China hasn't done well, you kind of like can capture the opportunity. Should it be a pure China fund, you probably would struggle to maneuver because everything is already put into China. The same with Hong Kong. By putting Hong Kong into it, it introduced another perspective in terms of investment. Hong Kong is a more mature economy, but more international, more focused on properties and banks. And so also Hong Kong, in terms of the companies, they're usually more westernized, more developed. You're kind of like replicating the business model into China. So it's a totally different, kind of segment in terms of the characteristics as compared to China and Taiwan. So by combining the three, we believe the risk could be reduced, the volatility could be reduced, and somehow, if you manage it well, you can actually try to allocate between different markets to generate better risk-adjusted performance over time.
And what is your outlook for the Chinese stock market over the next 12 months or so? It sounds like you're reallocating capital back towards it. Is that correct?
Yes. It is quite difficult to predict what's going to happen for the next 12 months or so. Usually we take a 3 to 5 years view or more. The intention has always been that we identify those stocks that we like. And if we can find those stocks and if valuation is appropriate, we just buy more of those stocks. For the last 2 months, we have identified more stocks that we like at the right valuation in China for the simple reason that everyone is now concerned about China. So we do think from that perspective, even though we don't want to give a number to the possible return, that the risk reward for the China stock market as of today is actually better than, let's say, 12 months ago. But I'm actually referring to more like the offshore market, whereby foreigners own a lot of stocks, the stocks listed in Hong Kong. But then for the A-share market, which I just talked about, the A-shares have actually been holding up very well because the domestic investors are not as concerned. So we believe the offshore China market, which accounts for the majority of the of our Greater China funds, we believe the risk reward is actually better than 12 months ago.
Martin, that's been very interesting. Thank you very much for joining us today.
Yeah, thank you, James.
And if you'd like to learn more about the FSSA Greater China Growth Fund, please visit FundCalibre.com and please remember to subscribe to the Investing on the Go podcast. Please remember we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at your time of listening.